Hi everybody, welcome back to the online lending technology think tank. My name's Colin White from Credit Connect Media. I hope everybody is well. For people who joined us in the last session where we discussed business transformation, we hope you enjoyed it. It was a really good conversation. So if anybody missed that, these sessions are being recorded. So they should be available 24 hours after this event on demand. So let us feel free to tune into that and have a look. For those who just joined us, we're going to be discussing credit risk strategies very shortly. But before we do that, I'd just quite like to go through the panel or the screen that you can see in front of you. If you minimize the video screen, you can see a number of options on there where we want you to engage if possible, or just for your information, you can have a look at some background to the event. So as I speak, there's an I button in the top left. So that's got information on this event. It's got information on our next event where you can register. It's got a link in there built in. You can register for the next event, which is going to discuss affordability and the customer journey. That's going to start at 5 to 12. So if you haven't registered for that already, have a look in a bit if you're interested in that subject. Second one is key there. There's a question, like a speech bubble. You can use that to ask questions, type them in. We'll share them with our panelists if they feel comfortable. They'll answer that. And then you've also got the picture, and you can view information on our speakers today, have a look at their profiles. There's a couple of download information pieces in there as well. So have a look at that. That's got information on Credit Connect website, but also we're bringing this discussion alive next month face-to-face at our Credit and Collections Technology think tank in Manchester. So I'm not going to plug that too much, but have a look at that as well. And then finally, a bit of information on our event supporters for today. So enough from me. I'm going to hand over now to Chris Warburton from our strategy, who's going to who kindly chaired our last session as well. He's going to introduce our panelists and begin the discussion, and you'll see me at the end for a little bit of a roundup and just close off the session. So Chris Warburton, over to you. Thank you.
Thanks, Colin. Hi, everyone, and welcome to people who just joined. My name's Chris Warburton. I'm going to be the chair for this event too. I suppose this event here, we're going to talk a little bit about credit risk, and it's been quite a roller coaster, I think, for credit risk teams over the last sort of 18 months. And it's probably not all over is the reality. I think we're all thinking we got economic changes basically starting to ripple through the economy, and we've got changing customer needs. Customers have now got maybe different ways of interacting with companies. They might even have different income streams as well. So there's nothing short of lots of change that's essentially going on. So we're going to talk a little bit about that in this session here, and around credit risk and how we as credit risk teams need to react to that, and what's the technology that we need to use to really help with credit adjudication, etc., and get ready for the near future. So with me today we've got Stuart Daniels. He's the Financial Services Director from Freeman, Gratton Holdings. Hi, Stuart. We've got David Wylie, who's the Managing Director of LendingMetrics. David, thanks very much for joining us again as well. So to both of you as well. So welcome, and we'll kick off. We've got a great session lined up. So to start off, I suppose I want to talk a bit about the last 18 months, and I suppose what did the pandemic, I suppose, do to risk appetite, particularly over the last 18 months, and then sort of where we sit today. I mean, Stuart, do you want to just maybe start with that from your perspective at least?
Yeah, sure. Good morning, everyone. So I think the pandemic was the dreaded black swan event that everyone was concerned would one day come within credit risk, where kind of prior predictions and prior performance was not a good predictor of future performance. So it was a very sensible thing, and I know that happened a lot in the market, that people were concerned about what the outcome would be and were reducing risk appetites. I think, speaking for the retail credit industry, what panned out was, I suppose, the opposite of what we expected naively to start off with. In terms of demand, I think with physical bricks and mortar retail disappearing for a while, the kind of online retail sector was booming, and we definitely saw that. And also in terms of risk and repayment rates, I think with government support, with furlough and payment breaks, and also people just spending less money and having more disposable income, I'm sure, again, we've seen this across sectors, that repayment rates and arrears levels have never been so good. So despite the feeling that risk appetite needs to be reduced at the start of the pandemic, that hasn't panned out. But as you kind of alluded to earlier, Chris, I think almost the position we're sat in at the moment is more risky, given that we're coming out of lockdown, so disposable income's under pressure. People are commuting again. If my commute into the office is everything to go by this morning, a lot of people are commuting.
Yeah.
Again, government support is being started to withdraw, and furloughs ending, payment breaks are ending, and we've all seen what's going on with regards to things like fuel prices. So I only see increased risk in the future. We've started to see that come through in terms of payment rates and arrears as well.
And I suppose from a a creditor point of view, or from a lender point of view, I imagine there's probably also quite a bit of pressure to get back out in the market. I mean, David, I know you've been sort of quoted before talking about pent up demand that's sort of been out there. I mean, are you sort of seeing that with some of your clients too? As the way on the back of really, I suppose, the pandemic, so it's taking into account, I suppose, some of the stuff that Stuart's just said.
Yes. So, morning, everyone. Just on the appetite side of things, risk appetite side of things. First of all, we're not a lender, so we don't have that first-hand experience. But what we do have is a sort of a broader view of the marketplace via the work that we do for our lender clients and the ongoing dialogue that we have with them. And so the risk appetite, I had a few very interesting conversations with clients in the lead up to this session, telling me stories around how when the pandemic first broke, they were having board meetings trying to figure out what they should change. Surely we have to change something. The world's changed. What are we going to change? And actually, many of them resolved to change very little indeed. One main reason for that being there are so many changes out in the marketplace. How will we know what's worked? And lo and behold, to echo Stuart's comment, the net result of all of this increased perceived risk is record repayment rates, and that's come in for some lenders alongside a reduction, certain sectors, that is, a reduction in demand because people have not needed to borrow. They've been repaying loans rather than taking credit. And in terms of the pent up demand, well, I think recent events are just going to amplify that. Really, yes, people have been taking payment holidays. People have been receiving government support, and they've not been spending money the way they used to be spending it. But as we're seeing from the reopening of international travel and reopening of retail, there is a huge surge going on. So people want to spend that money that they weren't spending before, but now they have all of these added costs on top, which is the increase in fuel prices, the ticking up of inflation, shortages in shops, which are feeding through into higher prices, and the Bank of England themselves talking about the risks of inflation. So yes, we are seeing volumes increase. We've not seen them explode yet, although I would say, based on all the conversations I've had with clients, November is earmarked to be particularly big. And again, this is all, some of this is anecdotal, but look at everyone being forewarned about whether there'll be stuff on the shelves for Christmas. Yeah. So I wonder how that may translate into everyone getting ready extra early for Christmas this year, and hence the October, November window.
Yeah, and I suppose so. It seems like there's almost like this demand on one side as consumers sort of get back into the market, and yet there's these increasing risk factors as a result of that. I mean, how do we think about sort of price? How people think about sort of pricing some of that in? Because obviously you want to lend to make, to grow the book, but you have to take those other factors into account. I mean, so is there upside, or is there opportunity in there, or is it just do you think just sort of perceiving that as risk? Stuart, so what are your thoughts on that, sort of as we stand today?
I think, as I mentioned earlier, I think this won't be true across sectors, but distance retail, we've not seen the drop off in demand. Specific reasons for that, and we're expecting that uptick in demand to continue. It's our traditional peak, but we are definitely more concerned than we were 6 months ago about the downside risk, particularly if people overcommit in the run up to Christmas and what happens in the new year, which is the traditional arrears peak for us. So we're thinking now about, and it's difficult. We don't have the exact answer on what we do, but we're thinking now about what do we do in this peak period. To David's point, we're already starting to see an earlier demand peak than we would usually see. So people are definitely bringing their purchasing choices forward. I think there's, especially on bigger ticket items as well, there's supply chain issues that have been rippling throughout the market. So people know that lead times on certain purchases are taking longer as well. So that's another factor. But we are thinking about what we do in terms of risk appetite right now to protect ourselves from the downside risk beyond Christmas.
And in terms of underwriting, I suppose, does data and new data have a part to play in that in terms of just getting greater granularity around it? Understanding what's going on?
Yeah, I mean, absolutely. I mean, you would expect to say that as a data person, more data is always good and can lead to better decisions. But I think one of the things that we are seeing, given that the affordability rule changes that came in back end of 2018, we're starting to see a lot of the downstream outcome data and performance off the back of that. So a lot of the extra data that we were collecting from customers, again, probably new to the retail finance sector, doing more thorough affordability assessments. We're starting to see what that is telling us in the long term now, which is interesting. So some counterintuitive stuff like disposable income calculations not being that predictive in terms of future risk. But some things like income verification being very, very predictive. So we've got the opportunity to use some of that data. Now we're seeing the outcomes of that in a kind of more granular way.
And David, I mean, how from your clients, I mean, how active are they in terms of like looking for new data sources to try and make better decisions and really understand what this risk is? Is that a hot topic at the moment, or is that just something that's really starting to build?
So there's a real thirst from both prospective customers and existing customers to engage with us to find out who we know about as well. So we're always talking to new data providers. They want to be a part of our platform, and we want them to be a part of our platform, and our clients want to know about them. So yes, that's an ongoing theme, really. Everyone's always looking for that angle, that little piece of the jigsaw that they can use in a sort of particularly nuanced way. I think the biggest trend right now is the velocity of changes that are happening now, as opposed to the velocity of changes that were happening running into the pandemic. I think lenders are now reassessing risk now that the pandemic is not over, but certainly we would all like to
stabilize.
Yeah, we're through the worst of it, and their ability through technology to respond quickly to make those changes quickly to their credit policy, rather than knowing that they're making credit decisions on outdated assumptions, outdated policies.
And going back to the data piece, I mean, flexibility, that definitely sounds like that's key. And going back to the data piece in terms of like the new data sources, I suppose, that you've got access to or you want to get access to, I mean, what kind of, I mean, Stuart, you talked a bit about having data from a few years ago that you're now using. I mean, how do we need to think about due diligence for the data that's coming on board, and then how does that then get wrapped into the models? I mean, how long can it take to get these things up and running? And coming back to your flexibility point, David, in terms of like, you've already got the data there. I mean, how quickly can it be implemented to get that extra granularity around, really credit decisions, I suppose?
I suppose the answer is it depends on your technology stack, which is why there's not a lender out there that isn't trying to create an environment where they can be more flexible, because there's three challenges, isn't there? There's getting your hands on the data, whether it's internal or external. There's modeling the data to see if you can actually add to your predictive power. And then there's actually executing decisions off the back of the models. And all three of those are different challenges. Quite often I've been in environments where the first two parts of those are the easy bit. You can actually get your hands on new data. You can find out it's really predictive, but actually productionizing that and making decisions in a live environment is the last part of the kind of journey that's really, really difficult. And your technology stack needs to cater for that. And that's a challenge we're facing into at the moment. It's certainly not where we need to be. One of the areas I'm focusing on a lot is to make kind of that end-to-end decisioning journey more flexible, so we can benefit from some of the new data sources that come to market. Everyone's speaking about open banking a lot. We already know from some of the work we've done that if we can get customers to sign up to that journey, which is another particular challenge, that it is going to be really powerful. But we don't yet have that kind of productionized process to take that data, to model it, and to make live decisions while customers in channel off the back of it. So that's kind of the challenge we're facing into.
And David, I'll just get you to comment, I suppose, like speed of adoption of this new flexibility that's out there. I mean, is it gradually picking up speed? I know some of this stuff is important. Some of the stuff that you guys have been doing, but I mean, are you seeing it sort of gradually pick up speed in terms of people adopting a much more flexible approach, or are there still a lot out there that's still doing it the way the old ways of doing things?
So interestingly, 2020 was a surprisingly good year, and that's because the type of platform that we deliver, and I guess other companies that do things similar to us, we're involved in projects which are planned well in advance, and so therefore I think the perception, in fact we know that with some the perception was, hey, this is a 3-month bump in the road, so let's just push on and get the implementation done, because we're coming out of this thing faster and stronger. So 2020 was pretty much unaffected, all bar a couple of months of lockdown. But 21, we've seen the bigger organisations still engage and come on board, but those sort of mid-tier organisations, and in particular the investors behind them, I think they've more of a tendency to wait at the moment. They're not cancelling projects, they're just actually waiting to see this thing come to an end, simply because it's probably gone on much longer than a lot of people originally anticipated in the early mid part of 2020. But that being said, we are certainly seeing a whole swathe of lender types adopt automated decisioning, and actually one of the most active areas for us, and this I think illustrates how extensive the message is getting through in credit, and is the building society sector. Building societies have traditionally been very conservative, and much more of a personal, hands-on touch, which they're still very, very keen to retain, but they too realise that they must build in more consistency, faster service, and couple that with the personal touch. So yeah, it's definitely going in the right direction. And to finish off that point, as we get further into the year, this final quarter, it's become apparent to us that a lot of those investors are now starting to make the decisions and make the funds available. So it finally seems to be unblocking.
It's quite interesting what you're saying around the around the market in 2020 versus 21. I mean, a couple of folks have said that almost like the 2021 lockdown was almost like the hardest because it was almost like it was the re-lockdown, if you see what I mean. So it was, and that almost like caused a bit of a pause. And it's quite interesting what you're saying in terms of market dynamics.
Mm-hmm.
So, and data, the data itself, and go back to yourself, Stuart, the data itself has also changed during lockdown as well, right? So people have been making payments, they've been paying up, maybe they had extra income as a result of it, maybe they're less income because they're on furlough or they're on benefits, as an example. How do you think the data itself over the last 18 months has changed? I mean, has it fundamentally changed? And then what's your approach going forward? I mean, you've got the data for the last 8, do you throw that away or do you go back further? And how are you thinking about that from an assessment point of view?
Very difficult question to answer. Again, so excuse me, loud outside. So yeah, I mean, I think this particular year, is it truly representative of what we're going to see in the future? It's really difficult to say. I think there are a few trends that will persist. So I think, again, people working from home, so pressures on travel expenses, again, won't necessarily be at the level they've been throughout 2020, but will people ever be spending what they used to spend on travel? Probably not. People have spent a lot of money on their homes, and we've been the beneficiaries of that in certain respects. So maybe people will be going out and going out less frequently and spending less money in the future. But one of the things I am particularly concerned about, and I mentioned this to the FCA at the time, which I can completely understand the sentiment of not recording payment holidays at the credit bureaus, but the fact that we are potentially blind to that data, it is a big concern. Obviously, people that were asking for payment breaks are higher risk. That is absolutely true. I am really keen that we're trying to capture that data as people come off payment holidays, and we're looking quite closely to see what read we can get in the early months of furlough ending and payment breaks ending, so it might be predictive of kind of ongoing performance.
So do you think your models are is there a risk that the models are going to over-predict or under-predict risk, like risk of default, as a result of the last 18 months? I mean, or do you think it's all going to come out based in the averages in the wash? You're just going to get greater standard deviation, almost like deviation, I suppose. I suppose
it depends when you built your model.
Yeah.
And so if your sample period for building the model was the last 12 months, it's going to under-predict risk is my very first view. So again, we're looking to see in previous models that we've built on kind of more normal years, overlaying that to recent performance. Is that a better short-term view on kind of where our lending decisions should be based?
And I suppose this comes back to your point, David, around flexibility, right? And sort of just making sure that you can change the models if you need to. Is that kind of what you're seeing people trying to do in the market?
Yes, we are seeing record numbers of should we say adaptations to the credit risk models within our platform. Just going back to the actual data itself, though, I think the one thing that we are in danger of overlooking when we talk about, is the position becoming more risky? Several of our clients have made it very clear that the biggest single predictor for them to risk is the unemployment rate, and look at the sheer number of vacancies that we have. When you look at the rate of wage growth factored into that too, so you've got high vacancies, higher rates of wage growth, and you now have a government that's defending labour shortages by stating that, hey, this is part of the transition to a highly paid, high productivity economy, where we aren't going to rely on imported cheap labour. So surely, that's going to be a pretty robust underpinning of the job market for people to be able to service their debts. And the problem that has existed previously, where we've been told about the working poor, well, if we have good wage growth as well, then it seems to me that's going to be a pretty positive influence on mitigating some of these risks that we see. And it also, there are some really very, very different perspectives on what data is important as we sort of emerge. There's one thing that never really crossed my mind, and when I was talking to some of our clients in the secured and the mortgage sector, they're less worried about the pandemic. They're now more concerned about the effects of climate change. So when you talk about mortgage and security, so where are we lending? Where are the flood areas going to be? Because this could be a 20, 30, 40 year piece of security on their books. Where's the coastal erosion happening? So different priorities in different sectors, not all by any means related to the pandemic.
So you talked on a couple there around sort of like, outsized risks that could be facing us forward, so climate change, I suppose the ESG stuff, like employment or unemployment or employment. It could be plus or minus depending on how you see it. I mean, what do you think might be some of the other risks we've got to talk about? I mean, inflation's been talked about in the new year. We talked about that a little bit on the last session, but I mean, do you see there's sort of over the horizon kind of risk that we've got to be planning for? I mean, because I think the last one took us by quite a bit of surprise, the pandemic at least. Any other thoughts?
Is that to me or to Stuart?
Either. I mean, so Stuart, do you want to take that?
Yeah, sure. I mean, David's right in terms of, I suppose we've talked a lot about the risk, but there are potential opportunities here as well. So the fact that there's a labour shortage should mean that there's a positive effect on wages in the future. At the same time, if there's a positive effect on wages, there's probably going to be an inflationary effect on prices. So how that's going to play out net is very difficult to predict. I'm not an economist, but there'll be some winners and losers from that. So I suppose in terms of, we've already spoken about it, in terms of the next 6 to 12 months, very much price and disposable income pressures is what I'm concerned about in our sector. Longer term, things like climate change, very, very difficult in our sector to work out how that will impact. Certainly for mortgage lending, that's very, very relevant. So there's some things sector by sector, I think, that are more relevant than others. But for our particular customer cohort, we're most concerned about inflationary pressures at the moment on prices.
Yeah.
Another interesting thing is, though, in terms of potential opportunity, people have had opportunity to build up savings potentially over the pandemic in a way that they've never been able to before in some of the higher risk parts of the economy as well. So the fact that they've deleveraged, they built up some savings, there should be some more kind of a buffer, more robustness that persists once the pandemic is over as well.
Yeah. And how much do you think this brings new opportunities, even to expand into new markets? And can the flexibility and the digital flexibility that we talked about, is it an enabler to launch new products and new markets? I mean, what are the considerations around that, really, I suppose? I mean, David, do you want to maybe just comment around some of the things that maybe you've been seeing? If we do move into an expansionary kind of phase, is that something we've got to look at?
Retail point of sale, that is the elephant in the room, isn't it? It's exponential growth, and one has to wonder where that will end. There is plenty of innovation out there, and what we are currently implementing projects for some clients with some really new, novel angles on credit. They absolutely crucify me if I were to divulge what they were here on a public platform. I think there's always, every single day, there's a new idea on how something can be launched in the credit sector. But I think I think the retail point of sale is by far and away the biggest. but it's also one that probably needs to be addressed by the regulator. There are concerns around the degree to which it's argued that it isn't credit, that it's not a credit agreement because there's no interest being charged, but then it is credit. We all know it's credit. It's a debt, and so is affordability being checked correctly? Is it just exploding because it's available, or is it exploding because it's the right product? And only time's going to tell in terms of performance on that. I haven't seen enough of the numbers to know yet, but I do talk to a number of people who are gravely concerned about the relative unregulated nature of retail point of sale in certain sectors, in certain markets.
And are there any watch outs if you're sort of sitting there in the audience thinking like, well, I've got a great new market I'm going to expand into. It's going to give me this new opportunity. Things that people have got to really think about that you'd say, well, look, just caution people to say, but you need to make sure you get this right before you go, running into like huge amounts of expansion just as you start. Any thoughts on that? I mean, David, just continue on, then I'll come to you, Stuart.
Affordability, number one, and can you defend it against a claims chasing company? That's a massive one. Hopefully that's going to diminish, but with new products come new angles, come new lines of attack. So it's got to be. It's great. Hey, it's easy actually to have a great idea, but to implement it in a compliant way and in a robust way, making a profit is arguably probably one of the easier aspects of the whole process. But making it sustainable and making it compliant, and those are two far bigger challenges.
Stuart, what are your thoughts?
Yeah,
around market expansion. Yeah,
echo a lot of what David said. Then clearly we're retail point of sale credit, but different sector to the kind of the BNPL disruptors. So kind of heavily regulated, and the FCA are very interested in our particular sector as well. Just to be honest about it. And we're looking a lot at Klarna, and both in two ways. It's an opportunity, and the likes of Klarna, in that clearly there's a huge demand for that type of product. On the other side, I am genuinely worried about some of the damage that's been done. Just very simple example, I don't know when somebody applies for credit here, how much exposure they have to Klarna type products. When there's an application to Klarna, they know exactly what their exposure is here. But because of the bureau reporting, the way it is at the moment, we're blind to that. So there's a risk there. I don't know what affordability assessment is being done at the moment. And it's heavily weighted to younger people. And I think when we're designing similar type products, we're going to have to think a lot about who is the target market, who do we want to take these products, and how do we want what outcomes should we be concerned about. And I'm absolutely sure that the regulator is interested in that sector, and it's going to come under the auspices of the FCA at some point, probably next year. That's a positive thing for everyone concerned, I think.
And do you think there are data solutions around that? I mean, obviously, is we got to wait for the regulatory aspect or the governmental involvement or ruling around that? Do you think there's things we can be doing in the short term from a digital point of view or from a technology point of view?
Yeah, there absolutely is, and again, our sector is doing that now. We have to in terms of robust affordability assessment, and again, we are mindful of the risk about the claims management companies moving from kind of the PPI redress world into irresponsible lending type activity. So that's something that everyone in our sector, credit card markets, is experiencing at the moment. So there's lots of reasons that you need to be really, really robust, but mindful of the fact as well, proportionality. People aren't. It's not a mortgage application, so it's finding that balance. Sure that your affordability assessment is robust, whilst not being a huge process for the customer. Plus, because it's an ongoing credit relationship, making sure you're keeping an eye continually on the customer. So looking for risk indicators that might emerge and taking action off the back of that.
So the question just come in there around machine learning or AI. I mean, Stuart, do you think that can you use that? Is that a bolt-on you can use to sort of add additional intelligence to some of the decision that's there already?
I think, yeah, absolutely. I mean, it's another way of predictive modelling. Where I've seen a lot of success is particularly around fraud prevention. So some of the applications of machine learning and AI in that particular part of the journey have been really, really successful. Credit risk is a little bit more difficult. You've got the explainability type angle as well, which I know a lot of people are wrestling with, and the regulator is interested in as well. But for me, it's another way of modelling the data that can lead to better predictive models. So ultimately, if you're making better predictions, you can achieve better outcomes for the customer. So it definitely does have a place in my view.
Yeah. David, any thoughts on that, or
we are integrated with I think two machine learning / artificial intelligence. I believe they're actually machine learning. I think those two phrases are often intertwined when they shouldn't be. So we're integrated with a couple of providers. The take up is very low. We don't have many customers at all who consume that type of service as yet. They're relying upon more tried and tested methods, and frankly, still trying to grapple with how they can use open banking data effectively, and that is obviously a big affordability tool, but it's still to be fully understood, and the degree to which it impinges on the customer journey then does make it, by definition, a bit more self-selecting in terms of sector. The hoops that you'll jump through for a mortgage are going to be quite different from the hoops that you'll jump through for a £500 or £1,000 loan, and particularly if you're being asked for your bank details, or you've been asked to log into a bank account, the public don't yet get it in big enough numbers, so they have that natural suspicion about giving their details, and then of course, if only one of the 10 providers is asking you for that, guess what? You'll go to one of the other 9 and have a more straightforward journey. So it's going to be a slow and gradual level of adoption for open banking. So yeah, back to AI machine learning. It's not a big matter on our radar at the moment.
Yeah, that's quite interesting in terms of, you're just saying there around almost like customer friction in the application, the originations journey becomes a competitive advantage, right? So if you have lower friction, then it becomes a competitive advantage for lenders versus higher friction. And open banking could be seen as friction in some of that. I mean, if it's not implemented properly, or if it's not explained properly, because it can be a help as well, can't it?
It absolutely is a significant point of friction, not least because of the time that it takes to go through the login process and how that impacts on the whole sourcing of business. But then, what's happening to my login details? Who am I actually giving them to? Where's all this data going? Crikey, there's all of my bank account information, and I only want you to really know about my income, but there's all this other stuff on there. And we know that there's people who gamble, so do they really want to know? Do they want creditors or anybody to know about that they're gambling? It's a tough one, and it's taking time.
Yeah. I know, and it's shameless plug. We have a session on open banking later, so that's a question we can definitely ask and definitely explore around friction, because it does give quite a bit of extra information, right, that you can use from a risk assessment point of view. I mean, Stuart, looking at yourself, I mean, in terms of like being able to use that, it becomes, I suppose, it's what's the value exchange for that information to a certain extent.
Yeah, absolutely. So and some of the information you mentioned, gambling, gaming, that is from the work that I know has been done, very, very predictive of risk. And to a certain extent, customers will understand that as well, which it's an interesting kind of conundrum for the customer to almost get access to at some point in the future. I think this will be commonplace.
Yeah.
Interesting to see if that actually changes people's behavior.
Yeah.
So if people start to understand that if they're gambling, they're less likely to be accepted for a mortgage or a loan, will it make people gamble less? It's an interesting thing that might transpire in the future, but there has to be a value proposition. It's difficult, as David mentioned, for lower value type credit for people to give us their bank account details, for instance, for £500 definitely seems like overkill. So we're thinking about almost boosting that message to customers where it looks like we need more information. Thin files is an obvious example where we need to know more about you in order to accept. Therefore, can you fill this open banking application out?
It's almost like the tailoring of that information when you need it and only when you need it.
But to enable to do that, you need flexible systems. So it all comes back to the original point, really.
Yeah. Okay, well, we're almost out of time, and it'd be good to just sort of go around just in terms of what do you think the future of credit risk management is going to look like? I mean, and what's the technology look like as well? I mean, so if we're sitting here in 5 years' time, what do you think it would what would it look like if we're having this conversation in the future? David, do you want to go first?
Wow, goodness me! if I knew that, if only I knew. Well, everyone's going to be using ADP for starters. I mean, that's a given. But no, seriously, there's clearly been a shift, and it's going to continue from the face-to-face to more and more and more online. The technology has to be fast, it has to be secure, that goes without saying, but it has to be able to put the control in the hands of lenders to respond, because if we think that it's going to be plain sailing now for the next 5 years, it clearly isn't. That there are going to be other events, we just don't know what they are. We've got countries in the world like China, North Korea, Iran, Russia, and we've got a very sort of unstable geopolitical situation, more so than I can remember. So that things are going to change, and there's going to be external threats that are going to impact on people's confidence to buy things, to borrow, and that just means change. So being able to respond to change and being able to measure the benefit of those changes. Yes, there'll be plenty of new data sources. There always will be, and open banking's probably been the biggest one we'll see for a while, in my view. But it's going to take years to bed down. I don't think there's going to be anything as significant as open banking in the foreseeable future, but it's going to be about responsiveness.
Okay. And Stuart, what's your view on what will be like in 5 years? What the processes look like?
Honest answer is I don't know exactly, but I think some things will definitely be. I think things will be entirely digital by then. I think kind of offline processes will be very, very rare. I think we'll be a lot further up the adoption curve on open banking. Again, understand there's a lot of reticence out there at the moment, but again, especially younger generations are less concerned about sharing their data to get access to goods and services. And then just generally less monolithic kind of platforms. So it's buzzword, isn't it? Agility, but the lenders that can adapt and change quickly are the ones that are going to have kind of modular platforms where they can make changes quickly and fleet of foot, so they can deploy new models or they can have access to new forms of data as those become available.
Okay. And that's definitely the theme that's come across, is that flexibility, agility piece, and being able to respond in terms of creating and rewiring the systems as new data and new things happen. It definitely seems like that's been definitely a theme that's come through, and people rewiring it for that. So Well, David and Stuart, thanks very much for joining us today. Really appreciate it. It's great to have some such great speakers and real experts as well. So thank you very much, and really appreciate it. I'm going to hand back to Colin.
Lovely. Thanks, Chris. That's brilliant. And of course, Stuart and David. No, it was really good, really interesting. And really, actually, it's hard to not talk about some of these things without talking about some of the things we're talking about in our future sessions. Customer journey, affordability, obviously massively important. Especially with what's going on with the new unregulated lender that's out there at the moment, and how that will change and how that might impact what has gone before as well. That'd be really interesting to see. So thanks for everybody who's tuned in. On our next session, we're going to be looking at the customer journey and affordability. So that's going to start 11:55. There's a link in the platform there if you want to log in now. Nice and early, that'd be great. We've got a bit of a break now until that. So grab your cup of teas or get back onto your emails or whatever you need to do. And we hopefully see you in the next session. And just wanted to round up by saying a big thank you to obviously Chris for chairing that session. He'll be joining me in the next one. Stuart and David, some really interesting insight there. That was fantastic. And we're going to leave this session now and hopefully see you all again soon for our next session or next event. All right. Thanks a lot, everybody. Cheers.
Thanks,
Bye-bye.
Bye.